This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
At the end of the previous lecture, I introduced the idea and the point of law that states that a public company is not able to commence trading until it has a trading certificate. So here we are now on trading certificates. Public companies aren't allowed to trade until they've received a trading certificate. They have to apply for one to the registrar of companies, and the registrar will probably grant a trading certificate. And then, and only then, is a public company entitled, allowed to commence trading. Issued by the registrar, therefore, following an application made by the company. And the application states basically three things. First of all, it confirms that the nominal value of issued share capital is not less than £50,000, or the euro equivalent of £50,000, or even, this is interesting, or even a combination, a mixture of pounds, sterling, and euros. So that's a possibility. We have to confirm to the registrar that this is the case. Secondly, we have to identify within this application, we have to identify how much money has been spent or incurred in the creation of the company, the promotion and the formation of the company. How much has been spent or is to be paid in respect of the formation of this company. And then thirdly, we need to identify the identity of the person who has been paid or who is to be paid these formation expenses, these preliminary and formation expenses. So those matters are identified as a standard form. Those matters are identified on the form, sent off to the registrar on the application for trading certificate form, and the registrar, if happy, will then submit or send off a trading certificate. So now a public company has a certificate of incorporation and a trading certificate, and then it is entitled to commence business. But what happens if it starts business without or before the receipt of this trading certificate? Well, the application must be accompanied by a statement of compliance that says we have complied with, and the signature on this form will say we have complied with the law to the best of our knowledge and belief. But if it does commence before the receipt, the innocent third party that does business with this company's public, doesn't apply to private companies, with this public company that has commenced trading before it got its trading certificate, how could an innocent third party have known that it's a public company without a trading certificate? So the law protects the innocent third party and says the contract is valid so far as the third party is concerned, and the third party can sue to enforce that contract against the company and can sue to claim damage, and the company can't defend itself by saying, oh, the contract is void because we didn't have a trading certificate. No, the company cannot defend itself because the company knew that it didn't have a trading certificate. The innocent third party could not have known. The company and any officer in default, any officer who knowingly is an officer of the company, of the public company that has not got a trading certificate, is liable to a fine. And if they're persistently in default of similar requirements, they could very well find themselves being banned by the court under the Company Directors Disqualification Act if they continue to break the law or continue to ignore the law as it is written. If a public company fails to obtain a trading certificate within 12 months of incorporation, this is one of 6 grounds whereby an interested party can approach the courts and say, this is a public company. This public company has not obtained a trading certificate within 12 months of its incorporation. May I ask that you dissolve the company, that you put the company into compulsory liquidation? And the court may do. The court may say, well, why have you not obtained a trading certificate? Well, kill you off straight away. So that's a possibility. We move on now to advantages of being a company as distinct from being a partnership. In the last partnership lecture, I was identifying the differences between a partnership and a company, a separate legal entity for a company, but not separate legal entity. Do you remember the mnemonic learn fast rats? We had all these different differences between partnerships and companies. Now, this is something which has tripped up students in the past, because a question may ask you for partnership and limited company, and students have misread this and said, what are the differences, and identified learn fast rats. But in fact, that's not what the question is asking. The question is saying, what are the advantages of trading your business organization in the form of a company as distinct from a partnership? Not what are the differences, but what are the advantages of being a company as distinct from being a partnership? And here we have them. We got separate legal personality. Now, Salomon and Salomon, I said to you, there's no need to know case names, but if there's one case name that you should know, it's this one. This is the grandfather. This is the start of formal acknowledgement that a company is a separate legal entity, separate from those who are beneficially interested in the success or failure of the company, separate and distinct from those who manage the company's affairs, the directors, the board of directors. A company is a business, is an entity, it's a person in law. And Salomon, I think it was something like 1896. Dates are not important. Just put that into context, that it's an old established principle that a company is a separate legal entity, and it was established by the case Salomon and Salomon. It was confirmed. It's been confirmed by a number of cases. Adams and Cape Industry. There's one called McAura and Northern Assurance. But there are many, many cases which illustrate that, following Salomon and Salomon, that illustrate that a company is a separate legal entity. Partnerships aren't. Now, is there an advantage in being a separate legal entity? Well, yes, there is, because directly resulting from that, and it's not in your notes, directly resulting from that is the fact that a company may sue and be sued under its own name. So the directors are not being sued. If you have an action against another person and that person is a company, you sue the company in the company name. And the company itself can take action. This is interesting as well. The company may have a claim against an individual director, but maybe the director is in control, but is not therefore letting the company sue him. But the company, acting through its majority of shareholders, may take action in the company's name to take action against the director. So a company may sue and be sued in its own name, and that is an advantage. Partners, unless they're joint and severally liable, provided they are jointly and severally liable, partners may be sued individually, separately, and successively. You wouldn't sue the firm in its own name, you'd sue individual partners. Whereas with a company, you wouldn't sue individual directors, and you certainly wouldn't sue individual members of the company. You would sue the company in the company name. Limited liability, how important is that? Well, how important is it when we have these 1,000 or so unlimited companies? Why would you want to establish a company without liability as a shareholder? Well, one of the reasons, I'll give you one of the reasons, but it's not the only one. One of the reasons is this. In English property law, it is not possible to have property registered in the name of more than 3 people. It is I know for a fact, personal experience or talking with people that are affected, I know for a fact that in Italian and in Greek law, property is registered all the siblings, all the brothers and sisters, and then the cousins, and so it spreads out and out and out. You finish up with a piece of property which is owned by 20 or so different people. And it can be, and I know for a fact again, that if one person is awkward because you need unanimous consent, if that person is the first named out of all of them, and they can hang on for, I think it's 10 years, and they don't resolve how to dispose of the property devolves back on that first individual, that first named individual. Most unfair. So in the UK, in England, this has been addressed as a problem, and so you can no longer register property in the name of more than 3 people. But what happens if a partnership of 20 people buys a piece of property? Then they can only register it in the name of 3 of those 20. Well, I want to be there. I'm telling you, presumably you want your name on there, and John wants his name on. So me and you and John will become the registered owners of this piece of property. And the other 17 partners, Ken and Tax Tutor and P2D2, they can go jump in the river because it's only registered. Well, that's not fair. And so what could happen is that a partnership will register an unlimited company, and the unlimited company will then own the property in the name of the unlimited company. So that would be one reason why you might have. But the major advantage of being a company is that you have limitation of liability for the members. There are exceptions, but limited liability for the members. So if the company goes bust, the aggrieved payables, the aggrieved creditors can't come knocking on the door of the members and say, you're a member of ABC PLC, you owe us some money. You have that restriction of liability. Perpetual existence, I'm not sure whether that's an advantage, but of course in a partnership where a partner dies, that's the end of the firm. There are ways around. You could say within the partnership agreement, as soon as a partner dies, yes, it's the end of the firm, but we'll create a new partner straight away. We'll create a new firm straight away. But with a company, when a member dies or a director, understand this, that the existence of the company is not affected. There is and I don't know whether it's an apocryphal story or not. It may be, I don't know. But there is a story that says during the Second World War, there was a general meeting of the company, all the directors, all the members, and all the family of the members, and the company solicitor, and the company's accountants, and their auditors there. Big do in London. And the building suffered a direct hit from a bomb and destroyed everything. All the shareholders and their families, all the directors and their families, and all the officials, and everyone was destroyed. And then out of the ashes came the company. You cannot kill a company by bombing it. So I'm sure it's an apocryphal. It's just like a make-believe story, isn't it? But you can't kill a company in that way. You can kill a company. Companies can be killed. Companies can commit suicide. But you can't murder it by bomb or by execution or by firing squad or by hanging. You can't kill a company in that respect. Giving it an overdose of drugs, no, you can't do it. Raising finance. Now I've left 2 spaces here. Raising finance because you can secure debts by way of floating charge. We'll come to floating charges and fixed charge. We'll come to that. Mention them in partnership. I did mention them in partnership, but I'm mentioning them again now. If you want to borrow money, you can pledge your assets as security. And as a partnership, you can pledge your assets by way of fixed charge, but not floating charge. You can't secure your debts by way of floating charge, and I can't secure mine by way of floating charge. I can, and you can, by way of fixed charge. Well, what's a partnership except a number of individuals, without separate legal identity? It's just a number of like-minded individuals who've created a relationship that subsists between two or more people, carrying on business in common with a view to profit. It's not a separate legal entity. So a company can secure its debts by way of floating charge. And it means that it can pledge its current assets, its inventory, its receivables. It can say to a lender, look, we've got all this inventory and we've got all these receivables in our records, and we want to release some of the money here. We want to get the money in quicker. We can use these assets as security to borrow money from you. And that will be by way of floating charge. But a partnership can't do that. The other thing of raising finance, it can invite the public to subscribe for shares in the company. But this only applies to public companies. A private company, by its constitution, a private company must be prohibited from inviting the public to subscribe for or purchase any shares or debentures. You can't have a public offer if you're a private company, but you can if you're a public company. And of course, partnerships can't. Ownership of property. A company owns its own property. The individual members of a company have no proprietorial rights to the property that is owned by the company. Different from a partnership, the assets of a partnership are owned by the partners jointly. Number of members, no limit. Well, I suppose there is the number of shares in issue. If everybody, the 87 million people, if everyone owned one share, and there was a limitation on the number of shares, then there will be a limit, the maximum number of shares that are in issue at any one time. But that's a theoretical limit. So there's no upper limit. There is a lower limit. You can't have a company with fewer than one person. So if the last sole surviving member dies, then the company, on application to the court, this is another ground for the court to grant a winding up order, where the number of members falls below the statutory minimum. Number of members in a partnership, basically 20. And you can't have fewer than two. You can't have less than or fewer than two members in a partnership, because the partnership, remember, is the relationship that subsists between two or more people carrying on business in common with a view to profit. Transfer of interest. Do you remember in the partnership lecture I had this Mohican hairstyle, green hair, stood through everywhere, coming in as a partner, and you said, no, we don't want him as a partner. You can't do that in a company. If I wish to transfer my shares in ABC PLC, if I want to transfer them or sell them or just transfer them to my son, you can't stop me. So transfer of interest is freely available in a company, but it isn't in a partnership. But of course, there are disadvantages. There are legal implications, a lot of legalities to go through with reference to companies. The expense and basically all these legal implications and publicity, it all comes down to money. It comes down to the expense of being a public company. Remember, I said that in the previous lecture, I said that it costs around £750,000 each year to be quoted on the stock exchange. Well, no partnership is going to do that, will they? No partnership can't be quoted on a stock exchange anyway. But there is the expense of 750 odd if you're a company wanting a public quotation. But here we go. The disadvantages, the expansion of the disadvantages. Legal implications, the formation. I've got to go through the formalities. Partnership, dead easy. The relationship that subsists between two or more persons carrying on business in common with a view to profit. Where's the formalities? You and me, partnership, Done. We're already now in a partnership. Now I'm going to dissolve it now before you sue me. Audit. Public companies only. Private companies no longer need an audit. Public companies do. So public companies have to pay for audits. And given that our public companies, 1,000 or so of them, quoted, substantial, they must be to pay $750,000 each year for a quotation. They're going to employ the big firms of accountants, and the big firms of accountants, almost by definition, are expensive. I'm not saying they're not good value for money. I'm just saying that they are expensive, and this is a necessary formality for a public company. Share issues. Yeah, the costs of issuing shares. It is an expense that private companies also face, but to a much lesser degree. Partnerships don't have that same expense. Meetings and resolutions, we've got to call all the people together. Australia has just had a vote with reference to, it's a voluntary vote with reference to same-sex marriages. They were going to have a mandatory vote, a requirement, where in Australia, if it's a mandatory referendum, you have to turn out and vote. You have to vote. But this one was a voluntary one. The reason they didn't have a mandatory one, because the no party, who don't want same-sex marriages, said it's going to be too expensive, it's a waste of money. So instead they had a voluntary one. Meetings are expensive. Big companies in the UK have to hire premises in order to get space for their shareholders and stakeholders to attend. When British Telecom had their first annual general meeting at the National Exhibition Centre in Birmingham, they chartered railways from the railway company. They chartered special trains to bring people from around the world, around the country. They had trains coming in from Glasgow and from Edinburgh and from York and Leeds and Sheffield and all the major cities all had trains coming in to bring these thousands of shareholders to this first public meeting at the National Exhibition Centre in Birmingham. So there is an expense in being a public company for having meetings and resolutions. Liquidation. Compared with a partnership, you and I finish, we're no longer in partnership. That's it. Not for a company. You have to appoint a liquidator, and they tend to be from one of the big four accountancy firms. They are therefore expensive again. So there's the expense there. There is a requirement in law that companies shall maintain, and it's a technical expression, proper accounting records. No such requirement for a partnership. You and I didn't keep any records, did we? No need. It's not a requirement. The taxman gets excited if we don't have proper records, but there's no legal requirement. Another one missed off here is that public companies must have a secretary. So it's a further expense. Further expense there. That the public companies must have a company secretary, and the company secretary has to be appropriately qualified, and the expression appropriate qualification is actually spelled out within legislation about what is an appropriate qualification for a public company secretary. Public, all these, therefore, if you think about it, all these could easily be categorized as expense. Details of directors and their remuneration that we know. We can see from their public company financial statements, we can see exactly how much each director is being paid. And we can work out and find out from the registrar of companies exactly which companies employ Mr. Parker as a company director. We can see from public records and public information. If you don't want people to know how much you're being paid, then don't become a director of a public company. Business details. If you're a supplier to a company and you're a major supplier and they're screwing you down and tightening their margin, tightening your margins and saying, no, you need to bring your prices down if we're going to continue. If they're doing that, And then you get a copy of their financial statements, and they are then selling on your goods at 100% markup. They're doubling the price of what they screwed out of you. You might be a bit unhappy, but that's the price you pay as being a public company. Publicity and disclosure. All your apparently secret information is now on open market, open forum, not for a partnership. Don't know the details of partners' salaries, partners' profit shares. We don't know the business details of how much their business they're doing and what sort of margins they're making. So there are disadvantages of being a company when compared with being a partnership. Lifting the veil, I was asked when I was active in lectures, I was asked more than one occasion, what is a veil? I don't know much about marriage ceremonies other than in the UK. I don't know. But in the UK, when a man and his fiancée get married, or nowadays, when a woman and her fiancé, female fiancé, or a man and his intended marriage partner, when they get married, certainly in the UK, when it's a heterosexual, when it's a man and a woman getting married, it's traditionally the case that the woman will wear a white headdress with it coming down over her face like that. And that's the veil. And so when the priest says, you may now kiss the bride, the veil is then lifted up, and that's the time when the bridegroom says, oh my Lord, what is it that I'm married here? But that's too late by then, because when the veil, it's this veil, that's what the veil is. It's the covering behind which the bride, inverted commas, is sheltered or hides. And a company has the same, because company directors hide behind this veil of incorporation. They hide behind the fact that it's not me you dealt with. Oh no, you didn't deal with me, you dealt with the company. And so they're protected in that respect because the veil of incorporation protects them. But to enforce that principle rigidly, without any degree of flexibility, would lead and has led to unfairness, inequity, unconscionable situations. So the court, reluctantly, but the court has in the past accepted that in the interests of fairness, we should lift the veil and say, no, we're no longer dealing with a separate legal personality company. We're dealing with you, the individual, from behind that veil. It doesn't like it. The court doesn't like to do it. The court will fight as much as it can possibly do so in order to avoid having to lift the veil. There are not many cases in English law where the veil has been lifted, but there are 6 here, 6 or 5, depends which version you have of the notes. I don't want to go into the detail of the cases. I shall summarize them for you, but I won't go into the fact that Mr. Horn used to be the chief executive of the Guildford Motor Company. Then he resigned or retired, but within his contract of employment, it said he would not set up in opposition for a period of 2 years. And he went home and he said to his wife, I've resigned. And she says, oh, what are we going to do? And he says, don't worry, I'm going to create the Horn Motor Company and you are going to be the director. He said to his wife, you will be the director. You will be the only shareholder, and I shall have a life of ease. I shall advise you. I shall tell you who to write to. I shall tell you the people's first names, but I won't take an active part. I will not be seen to be taking an active part. The court looked at this and said, it's a sham. Guildford Motor Company found out about this and said, but you said that you weren't going to compete with us for 2 years. He said, I'm not competing. It's my wife. She's running this business, not me. And the court said it's a sham. A sham company. This is a fraud, basically. It's a cheat. And the court said, no, not having it. But it was a properly registered company. Mrs. Horn was the director. Mrs. Horn was the only shareholder. Separate legal entity. Mr. Horn, nothing apparently to do with it. The court didn't like it and said, no, this is wrong. Daimler and Continental Tire. This is where a company had all its directors were German. The company secretary was English. But it's an English company. It was registered in England. And they ordered a supply of tyres to be delivered to North Africa back in 1941. Of course, in 1941, we're at war with Germany. And North Africa was one of the scenes of conflict where General Montgomery, the Englishman, was fighting head to head with the German army, the German Africa Corps. And so this English company with the English company secretary ordered from another company, English, and said, can you deliver these tyres to North Africa? And to do so, the claim went, Daimler said, oh, it might be, I can't remember which one was the English company, which was the good ones and which was the bad ones. But they said to the court, do we have to do this? Do we really have to deliver these tyres to North Africa? Because if you look at behind the veil of incorporation, you'll find all these Germans, just one Englishman. Is it right that you want us to send these tyres to? And the court said no, because you're effectively trading with the enemy, and that would be against the law. That would be illegal. So no, do not. We'll lift the veil. And what did they see when they lifted the veil? They saw a whole battalion of Panzer Division tanks. Ebrahimi and Westbourne Galleries. Two people in partnership, importing Persian rugs. Ebrahimi and his partner called Nazar. And they converted the partnership to being a limited company. On the advice of their accountants, they converted it to being a limited company because instead of paying 83% personal tax, by converting it to a limited company, the company then only suffered 55% corporation tax, which was clearly quite an advantage, keeping a lot more money back in the company. So they converted it, but everything else stayed the same. All the customers, all the suppliers, all their stock, their inventory, their employees, their offices, their warehouse, everything else stayed exactly the same. They changed the boat, they created a company, but it was what's called a partnership company. It's a quasi-partnership company. I'll write that one down for you. A quasi-partnership company. Never before thought I was created in this description created by the courts in this particular case. Then they invited in Nazar's nephew, who'd just finished business school. And he was so good. He was brilliant. And so they agreed that Ebrahimi had 300 shares and Nazar had 300 shares. They agreed that what they would do is they would each transfer 100 to George, who was Nazar's nephew. And so now we have 200, 200, 200. And then George said to his uncle, let's remove Ebrahimi from the board of directors. And Nazar said, we can't do that. It's a bit of a good friend. We can do it. All we need is an ordinary resolution. And we can do that because you and I have got 400 shares and he's only got 200 shares. We can just vote him off. And so they did. They voted off Ebrahimi. He was furious. He was really upset. Wouldn't you be upset? Well, hang on. He no longer has to turn up as a director. He no longer has to turn up every day to the office. He no longer has to make directorial decisions. He no longer has to be responsible for the running of the office. He's no longer buying and selling. He's got the life of Riley. He still owns a third of the company. He's still got his 200 shares. He's still entitled to his third of the dividend, or one third of the dividend, a third of the profits, building up his... Whoa. A third of what profits? Is that profits after directors' remuneration? Yeah. And so he's going to be entitled to a third of not much the profit. Say the company makes a profit of 330,000 or 3 million or whatever. And these two directors, George and his uncle Nazar, decide to pay themselves out 27,000 directors' fees. Then there's only 3,000 left. And that's then split 1/3, 1/3, 1/3 between Ebrahimi, Nazar, and George. Oh, no, not fair. So Ebrahimi goes to court. Well, the courts lift the veil. Yeah, okay, we'll lift the veil and we can see that these three, it's a quasi-partnership company, said the court. What can we do? Well, one of the grounds, this is the third one I've mentioned now, one of the grounds for dissolving a company is where in the minds of the court it's just and equitable to do so. And if it's just and equitable that the company should no longer exist, then the court will say liquidation. And that's what they did. And so he liquidated the company, revalued the assets, paid off the creditors, and then paid 1/3, 1/3 to Ebrahimi, Nazar, and George. And then Nazar and George set up another company on their own. But it's the only way Ebrahimi could get a fair distribution, get his fair share of his interest in the company. Now, I'm not going to go into any more because you're getting the idea, I think, that we lift the veil in order to relieve oppression, in order to prevent fraud, in order to make things fair and equitable, just and equitable. There's no point me going through. They're all three different examples of how wrong it would be to insist on this veil of incorporation. It will also be lifted under statute, where we have fraudulent or wrongful trading. I will get to those because when we get to the chapter on illegalities, I go into both fraudulent trading and wrongful trading. But basically, where a company is continued fraudulently with the intention of defrauding creditors, or where a company is allowed to continue without there being, this is wrongful trading, without there being reasonable prospects that the company will be able to avoid an insolvent liquidation in the foreseeable future. That's wrongful trading. So if it's set up with the intention of defrauding creditors, or if it's allowed to carry on where it doesn't have the reasonable prospect of avoiding an insolvent liquidation within the foreseeable future, then that will be fraudulent and wrongful. And the court will lift the veil because the directors of the company are potentially personally liable. Commencing to trade without a trader, said we already had this. We've already had this at the start of this lecture, the trading certificate. And abuse of company name is where a company goes into an insolvent liquidation. Let's say it's called Jeffrey Limited, and it goes into an insolvent liquidation. And Jeffrey's the only director, and he puts it into an insolvent liquidation. And then the day after, he sets up again Jeffrey 2017 Limited, sets up again as though nothing has happened. But he's taken all the assets out of Jeffrey Limited. He's taken those for his own benefit. Now he's putting them back in, and so crediting director's loan account. And it's wrong. It's an abuse of the company name. It's unfair. Other situations, when we prepare group accounts, if you've done F7 already, or if you've done F3, you're aware of the concepts of consolidation. Well, we treat companies within the one group, we treat them as though they were one company, that we just merge them all together and prepare a set of consolidated financial statements. They're not. They're all, each of them individually. They're each separate entities. And in law, they are separate companies. But for purposes of consolidation, we bring them all together. Tax law. The companies are allowed to surrender to other group companies. They're allowed to surrender their tax losses to another company within the group that is making profits. That's group relief, it's called. And so even though they are separate entities, the one making losses can surrender its losses to set off against the profits of another related company. And personal guarantees particularly applicable for small private companies, that where a company, a small private limited company, one director, two directors maybe, they want to borrow money from the bank say, yeah, there's no problem, but we want personal guarantees. So they persuade the directors to sign their name to a personal guarantee form, so that in the event that that loan is not repaid, then the bank can turn to these personal directors and say, now you owe us money in respect of this money that we lent to the company. You guaranteed that that would be repaid. So other situations then where the veil of incorporation is just ignored. Personal guarantees by a director to guarantee the debt that the company owes to an outside lender. And that will do, I think. That will do for this lecture. So we're going to stop there.